Credit cards are about to crash the economy. That's what many people are saying. Today, we're going to talk about that. Hey, everybody, my name is JJ. You're watching Bull Boom Bear Bust, back with another dose of economic reality. Before we get going, please hit that like button to try to get this video some traction. We need the word to get out there on what's about to happen. And, I usually don't put timelines on things, but it's getting to a critical point for the millions of people, the tens of millions, 100 million. It's more than 100 million people carrying credit card debt. Now, not all of those people have an amount that's critical that can't get paid off each month, but a big part of the population is not able to pay off their credit card in full each month. And wait till you look at some of the numbers we've got pulled up here for you today. Let's go ahead and get right into it right here. The average credit card rate just hit 22.7%, folks. That is a new all-time high for the rate on the typical credit card. Now, the scarier part of that is some people are paying even a higher interest rate. If you are late on a payment or something else happens, you go over your limit, your credit card company might bump it up even higher. I've seen 29% credit card rates for some people in the what's called the default rate. In September, credit card debt rose by just 3.1 billion. Now, in our previous report, we talked about how the third quarter was the biggest increase ever, but it did start to slow down in the final month of that third quarter, which was September. Now, to put this into perspective, let's rewind a little bit back to 2021. Credit card debt in 2021 was $770 billion. That was the first quarter, 2021, $770 billion. Now it's $1.08 trillion. That is a 40% increase in less than 3 years. And this is the cherry on the top right here. That was with student loan debt, student loan payments paused. What's going to happen now with the debt even higher? Credit card interest rates, all-time highs, and students have to attempt, and I want to stress the words attempt, students have to attempt to repay their student loan payments with all this going on. Folks, this is not going to end pretty at all. In fact, it's going to be pretty ugly and pretty nasty, and this can't last much longer. If I had to put a timeline on it, I'd have to say by the spring of 2024, it's over for the economy. Why do I say that? Because credit card debt is going to really handicap the consumer spending. And what is the majority of the economy? If you look at gross domestic product or the way economic growth is calculated, it's consumer spending. And what is most spending nowadays? It's mostly debt-driven spending. It's not savings. Savings has plunged to nearly an all-time low. It came back up or increased a little bit in the spring of 2023. But what are we seeing now here going into the fall and the winter months? It's dropping back down, and it's pretty low compared to norms over the last 40 years. Savings is really low. That's how much money people have left over in the month after they pay their monthly expenses and their bills. So not looking good at all, folks. I hope you're not one of the people buried under debt. There is an escape hatch known as bankruptcy. Some people just run up debt knowing that they'll ultimately file bankruptcy. So it's almost turned into kind of a game. And I know people that have done that, and they live very good lives. They travel a lot. They eat at the finest restaurants. They drive newer cars, nice cars. And pretty much every 10 years now, I think that's what's legal, is they're filing bankruptcy. But they're having a lot of fun in between. And even after they file bankruptcy, it's not the end of the world. Very good friends of mine just filed last year. They already have credit cards. They got qualified for a mortgage. A mortgage. All right? I'm not even joking. They got qualified for a mortgage with a bankruptcy about a year ago. Crazy, right? They bought cars. They got credit cards right after bankruptcy. So this is the game, folks, that's going on here. So the powers that be know that when the spending stops, when the borrowing stops, when people can no longer get credit, that's the end of the game for the economy. That's why you see people coming right out of bankruptcy, getting credit cards, qualifying for loans. because they know. The banks know. The people that run the banks know. The central bank knows. Everybody knows, right? Except for maybe most people. But people that run this system, that run the banks, of course, they know this, right? The politicians know it because they're on the payroll as well. Now, what's going to trigger the economic downturn? Well, it's going to be a slowdown in spending. And in my opinion, there's no way out of this. It's going to happen one of two ways. One is banks are finally going to have to pull back when people start defaulting on their credit card payments in larger numbers. People are already defaulting. The default numbers have already been increasing. But when it gets to a point where people start really defaulting, we're talking about 10, 20% of all customers defaulting, then that's when the banks are going to have to pull back on it. You're going to see more bank failures. Even if they do pull back on the lending, I think we're still going to see more bank failures, but that could really exacerbate the problem. The other option, or possibility, I should say, is that consumers just stop spending, or they really pull back on spending, knowing that they're having a tough time, knowing that the bankruptcy line is dead ahead. That could also be an economic downturn trigger. Because why? Because when people stop spending, and when they slow down spending, that's when the economy plunges, because it's consumer driven. So many jobs will be lost. When people stop swiping credit cards, if credit cards were to stop tomorrow, you would see unemployment jump up to, nobody knows exactly. I'd have to put an estimate. I'd say 50% unemployment. It would be an all-time high record unemployment number. That's how important it is for spending to continue. And that's how important credit cards are to the economy, because, again, most people without these cards wouldn't be able to spend this money, and economic activity would come to a screeching halt. So dangerous time, folks, with this interest rate just below 23% with credit cards, and the levels of debt, and the lack of savings, the overall cost of living. We're at the end time here. I don't want to say the end time. That's a biblical term. We're in the end game, let's say that, for this economy. And I think we're already in a recession right now. Of course, the ones that crunch the numbers are going to say, no, this number was high. Consumers are resilient, and they spent a lot of money. Yeah, they spent a lot of money racking up a lot of debt. So, of course, they're going to put that out there as strength. Look at all this spending. But what they don't factor in, or they do factor it in, they know this, but what they don't tell the public is that this is debt-driven spending. Debt-driven spending. The balances are exploding like never before. Just look at what we talked about at the beginning of the video. 40% increase in credit card debt in just under 3 years. That's pretty wild. And, let me know what your timeline is. There could be some other big situation that arises to cover up this whole collapse. Will it be war on U.S. soil? Will it be the whole banking system goes down and fails? And they'll blame it on somebody overseas. They'll say somebody hacked the system, right? And maybe it will be true. Maybe the system really will, if I could talk, maybe the system really will get hacked, right? I wouldn't take anything off the table right now. So wild time, folks, buckle up. Now let's go ahead and shift gears into a little bit of a different topic here. I've got a couple other big news items I want to cover for you today. I want to tie this in with what we just talked about with the credit card debt and the massive slowdown that we're going to see in the purchasing power of the U.S. consumer. And that is the big drop in oil prices. Oil prices slid here recently 4% just on Tuesday alone, just yesterday. And that's because of what we're seeing here is a big slowdown in consumer demand. All right, less traveling, people less able to do these trips and just take these fun vacations. Of course, there's always going to be people traveling, but it's going to be dropping, and therefore you're going to see oil prices drop if this continues. Now, you also have the inflationary side of it. We're very low here in the U.S. on our oil reserves. A lot of these strategic reserves were drained over the past few years to keep the price from spiking up higher. So if we get a bigger drop-off in production, not just the production cuts that we're already seeing, but something big that happens globally, maybe more conflicts. If we see a bigger drop-off in demand, that could really reverse the trend of falling prices. But The big slowdown was mostly noted in the following statistic. The slide came amid data out of China, which showed exports fell 6% year over year. And what is the biggest importer of Chinese made goods? Well, that would be the United States of America. So the writing is on the wall. We'll see what happens with oil prices, but it is something interesting, I think, to keep an eye on, along with all the other data here that we look at. Now, when we talk about the state of the economy, which is basically the state of the consumer, because the consumer makes up the bulk of spending that makes the economy grow. Let's talk about real estate here and mortgage debt. In 2006, 7, 8, before the housing bubble went bust, the amount of mortgage debt capped or peaked at about $9.3 trillion. That's trillion with a T. We just went over recently $12 trillion in mortgage debt. So you would think that at some point this bubble would have to bust as well. How it will bust and how soon and how hard it will be, I don't think anybody knows. Well, let's take a look at another piece of data I've got pulled up here. This is out of Wolf Street, by the way. This is newly delinquent mortgages, folks. We're starting to see an uptick. It's nothing dramatic yet, but I want to put this into perspective for you here. So we got down to a low of about 1.4% delinquent mortgages. That's really low. That's a low, the lowest in about 20 years. And that was actually mid 2021. Since then, we've seen an increase. Again, nothing dramatic, nothing crazy. But right now, we're just under 3%. I'm looking at a chart here. It looks to be about 2.9%. Still a pretty low number. But when it was just over 1%, and now we're approaching 3%, that's basically a tripling of the newly delinquent mortgages. Now, let's go back to 2007, 8, 9 again, because that housing bubble, everybody agrees, looking back, that was a housing bubble. So we have to keep going back to that particular era. And what do we see back then? Going into the housing bubble bust, let's say 2004, 2005, 2006, the delinquency rate was just under 5%. So it was already kind of high, even in 2004 and 5 and 6. It actually got up to 12.5% at the peak of the housing bubble bust. 12.5% delinquent mortgages, and we all know what happened after that with the foreclosures and everything else. So now we're just under 3%. So we have a long way to go. If we see this spike up to 4 and 5% towards the end of the year, then we'll know that the spring is likely going to be 6, 7, 8%. And that means by next summer, this current housing bubble could be approaching the way that it was back in late 2008, early 2009. Will it happen that quickly? We'll have to see. We'll have to see how consumers hold up through this, because this is going to be something very, very challenging for a lot of people. And will they pass laws and say there can't be any homes foreclosed? It's possible. Look what happened in 2020. So I can't say that there's going to be a bust for sure, because they could just pass laws to make the bust not happen, right? Pretty crazy times. How do you prepare for something like this when they can just move the goalposts, so to speak, and just pass new laws? You can't get evicted, you can't get foreclosed. Not that those things are good. Nobody wants to see 1 million homeless people on their block, but in order for prices to correct, you have to let markets do what they do. You have to let prices correct. You have to let prices fall. People will lose their homes in some cases, people that paid too much and people that lost their job. That's supposed to be how it happens in an economic correction. It's called a correction for a reason. A correction is when something is wrong, it gets corrected, right? You do a math problem wrong and you want to correct it and show the teacher. The economy needs to correct if it is wrong. Right now, the cost of living is wrong. It shouldn't be this high. It's abnormal. It's unusual. It's unprecedented. I mean, if you look back at several decades, this cost of living inflation is unprecedented, and it's wrong. It needs to be corrected. Will they let the correction happen? That is the big question. And what will that look like? All right, just a question I want to put out there. Everybody, thank you for watching. Appreciate you supporting this channel. Thank you for your likes and for your comments. I'll be reading your comments on this one because got a little extra time today, so maybe I'll even be chatting down there in comments with some of you. As always, everybody, peace, and I do mean peace. I don't want to see any war. I mean peace. Everybody, keep stacking. Bye for now. Peace.